If you think the drop in gold means the long case is dead, you are reading the market the way crowds always read it. You are reading price as if price were truth. It is not. Very often price is only pressure. And pressure has a way of creating lies that look convincing in the moment. I want to begin where most people refuse to begin, because it is less comfortable there. Gold near a record does not prove strength. Gold down hard from a record does not prove weakness. Neither one tells you enough. What matters is who is buying, who is selling, and whether they are acting from conviction or from necessity. Those are not the same thing. A buyer with conviction is building a reserve. A seller under pressure is raising cash. When you confuse those two, you do not just misunderstand gold, you misunderstand markets themselves. What I see in front of me is not a collapse in belief. It is a collision between long-term strategy and short-term survival. And when those two collide, survival always acts first. That is the part the public never learns until after the damage is done. A great many people have been told a simple explanation. The dollar is firm. Yields are high. Gold is correcting. There is truth in that. There is also not enough truth in it. The part that changes everything is that a meaningful slice of the selling is not discretionary. It is forced. That distinction is where fortunes are lost and made. When a person sells because he no longer wants an asset, that is one kind of signal. When a person sells because he has bills due, creditors waiting, or a fire spreading through the rest of his balance sheet, that is another signal entirely. The first tells you something about desire. The second tells you something about distress. Gold is not merely being judged here in important places. It is being liquidated to meet obligations created somewhere else. That is why I want you to stop looking at the gold chart as if it is a moral verdict. It is not. It is an X-ray of who needs dollars most urgently. In late March of 2026, the market was staring at numbers that looked dramatic enough to scare almost anyone who only watches the screen. Gold was around $4,428 an ounce, down roughly 21% from the January peak near $5,596. Most people look at a decline like that and immediately reach for the same sentence. The bull run is over. I have watched that sentence ruin people for more than half a century. It sounds intelligent because it arrives wrapped in a chart. But the chart alone is almost never the whole case. It is only the visible part of a struggle you have not yet bothered to identify. Fay file site. Fay turn 4 file. For Fay, the struggle here begins with dollars, not with gold. Turkey became the cleanest example of it. When a country imports most of its energy and energy is priced in dollars, an oil shock is not an inconvenience. It is a demand letter. When war shocks the region and crude moves violently higher, the extra cost does not arrive politely over a decade. It arrives now. The country needs dollars now. Its currency comes under pressure now. Inflation risks intensify now. And the central bank does not get to sit around discussing beauty and theory. It must defend the currency, calm expectations, and prevent a broader fracture. If it lacks enough readily usable dollars, it reaches for what it can mobilize. That is how a reserve asset turns into a source of emergency funding. The source document lays it out plainly. Turkey sold and swapped roughly 60 tons of gold in 2 weeks after the war shock, and the logic was brutally simple. Oil costs surged. Dollar demand surged with it. The lira kept making record lows. The central bank needed dollars to defend the currency and avoid a deeper spiral. Gold became the thing it could sell. That is not a philosophical rejection of gold. That is a nation discovering that crises do not care what you would prefer to hold. They care what you can turn into settlement power today. Fay site Fay turn 4 file 0 Fay. I want you to sit with that for a moment because it gives you a more useful framework than 1,000 opinions from television. A forced seller does not wake up in the morning, study the long-term structure of reserve assets, and calmly conclude that gold has lost its role. A forced seller wakes up inside a narrowing corridor and sells what can be sold. That is not strategy, it is triage. Once you see that clearly, the whole episode stops looking like a failure of the gold thesis and starts looking like a liquidity event inside a broader gold thesis. And Turkey is not the whole picture. The same document describes a wider shift across official players. Russia had already been selling gold to help finance war expenditures. Poland, one of the strongest buyers in recent years, was openly discussing monetizing reserves for defense. China had paused. India had turned into a seller under currency pressure. If you only glance at that list, it sounds like a referendum against gold. It is not. It is a map of who has been pushed closer to immediate funding needs. That is a very different map. Fe-Felicite Fe-Turn 4 File 0 Fe. The public almost always reads officials selling the wrong way. It hears central banks are selling and assumes the smartest buyers have changed their minds. Sometimes they have. Quite often they have not. Quite often they have simply run into a crisis that elevates dollar liquidity over every other consideration for a season. In markets, seasons matter. They can be brutal. They can also be temporary. Most people mistake temporary brutality for permanent truth. I have seen this kind of confusion before. The pattern repeats because human beings repeat. First, a long trend becomes widely accepted. Then some shock arrives from outside the asset itself. Then owners who do not want to sell are forced to sell. Price falls. The public interprets the fall as a revelation. More selling follows. Not from analysis, but from emotional contagion. People start telling themselves a story that feels rational only because it matches the tape. By the time they have fully persuaded themselves, the forced component is nearly spent. The price has reset. The weak holders are gone. The very action that terrified them has created the next opportunity. That is what a reset is. A reset is not the death of a structural case. It is the violent cleaning of a market by participants whose time horizon has suddenly collapsed. The document names 4 prior gold resets across decades and emphasizes the same sequence every time. Forced selling arrives first. Retail panic arrives second. Structural buyers return later after the liquidation pressure burns off and the crisis that created it begins to stabilize. That is not a romantic story. It is a market story, and market stories are usually written by who can wait and who cannot. Fe-Felicite Fe-Turn 4 File 2 Fe. Now I want to move one level deeper because this is where the real edge lies. A great many investors talk about gold as if it were a trade. I have never thought that was the most important way to think about it. Gold is not just a trade. At the sovereign level, it is insurance against dependence. It is insurance against the fact that parts of the modern monetary system work beautifully until they do not. It is insurance against counterparties, against sanctions, against the freezing of claims, against the realization that a reserve asset inside somebody else's system is never fully your reserve. The source document says it directly. When reserves can be frozen with a keystroke, countries learn that not every reserve is equally sovereign. Gold has no counterparty in the same way. It cannot be sanctioned in the same manner as a claim on someone else. Balance sheet, Fe-Felicite, Fe-Turn 4 File 3 Fe. That insight matters because it explains why a central bank can be forced to sell gold in a crisis and still remain a structural long-term buyer of gold. The sale does not cancel the logic. It proves the severity of the moment. When the moment passes, the logic remains standing. That is why I do not read Turkey. Liquidation as the end of the story. I read it as proof of the distinction between emergency funding and strategic reserve design. If you need dollars now, you sell what raises dollars. Now, if you still believe the world is becoming less stable, more fragmented, more fiscally strained, and less trusting of unprotected claims, you rebuild the gold later. Those two actions can come from the same institution without contradiction. One belongs to survival, the other belongs to structure. The public hates that kind of complexity. It wants a clean narrative. Up means good, down means bad. Buying means bullish, selling means bearish. Real markets do not respect such neatness. Real markets are full of institutions acting under constraints that have nothing to do with your tidy categories. The deeper you go into this, the more the numbers start to tell a coherent story. In the early 1970s, the fiscal backdrop and reserve system looked nothing like they do now. The document contrasts a United States debt load of roughly $500 billion in 1973 with something near $39 trillion today. And it argues that this is not merely a larger version of the same world. It is a categorically different world, one in which long-term incentives to diversify reserves and protect against monetary dilution are structurally stronger. It also notes that central bank buying in recent years has been far above the older norms and that the infrastructure and habit of sovereign accumulation are much more established than they once were. Again, that does not guarantee a straight line higher. It tells you the long-term floor under demand is built on sturdier motives than many people appreciate. Fe-Felicite Fe-Turn 4 File 2 Fe, that is the total line I want you to hold in your mind. Gold can be pressured by a dollar squeeze and still be strategically wanted. It can be sold by official holders under stress and still remain the reserve asset they prefer to rebuild. It can fall sharply without invalidating the reasons it rose in the first place. This is the identity flip that separates spectators from capital allocators. Spectators watch a falling price and ask whether the asset has failed. Capital allocators ask which balance sheet is under strain, which seller is voluntary, which seller is trapped, and whether the structural buyer has been converted or merely interrupted. If you stay in the first camp, you will always feel like the market is talking to you personally. If you move into the second camp, you start to understand that most dramatic moves have very little to do with your feelings and a great deal to do with funding pressure, maturity mismatches, currency defense, and time horizon collapse. I learned a long time ago that markets are not examinations of character. They are transfer systems. They transfer assets from the impatient to the patient, from the over-leveraged to the liquid, from those forced to act now to those prepared to act later. Gold is simply going through one of those transfer phases. The document frames the current episode in 3 phases, and I think that is exactly the right way to keep yourself from becoming mentally disorganized. Phase 1 is forced liquidation. That is the world in which the sale is real, the pressure is real, and the flow matters more than anyone. As opinion, Turkey is defending its currency, Russia is raising money around war constraints. Poland is discussing reserve monetization. There is near-term supply and markets respond to near-term supply whether they want to or not. Countries cannot sell more than they own, but what they own can still weigh on price until the need passes. Phaephilosite Phaeturn 4 file 4 phase 2 is stabilization. That does not begin because people finally become optimistic. It begins because the pressure mechanisms cool. If oil calms down, the extra dollar demand imposed on energy importers starts to ease. If the lira stops making fresh record lows, Turkey's need to keep finding dollars through reserve sales begins to moderate. That is why I would rather watch funding stress than sentiment. Sentiment is noisy. Funding stress is causal. The document explicitly points to the lira and to Brent crude as the indicators that matter most for detecting the shift from liquidation to stabilization. That is not glamorous, but markets are often moved more by plumbing than by poetry. Phaephilosite Phaeturn 4 file 1 phase 3 is structural re-entry. This is where the public usually arrives too late. The forced selling has already happened. The price has already been reset. The very institutions that had to raise cash begin rebuilding once the emergency eases, once the strategic logic reasserts itself, and once the market is no longer being fed by compulsory supply. By then the asset no longer feels disgusting enough to be a true bargain for the crowd. It has already started to heal. That is why the crowd so often buys recovery and sells reset. It does not understand the middle period well enough to act there. Phaephilosite Phaeturn 4 file 4 phay. Now let me give you the practical distinction that matters if you want to survive a period like this without becoming just another victim of your own emotions. You must separate the story of the asset from the story of the seller. That sounds simple. It is not. Most people cannot do it because they are too attached to narrative symmetry. If a prestigious seller is selling, they assume the asset's case must be broken. But sellers are not always delivering philosophical messages. Very often they are delivering collateral. If an importer needs dollars to pay for energy, if a central bank needs dollars to defend a collapsing currency, if a government needs liquidity for war or defense, if regulations or export deadlines change the timing of flows, then the sale tells you first about constraint, only later, if at all. Does it tell you something about conviction? The source document's discussion of Russia's April 2026 export deadline makes that point in another form. Pre-deadline liquidation can add pressure now, and then the pressure disappears while future supply tightens. Same market, opposite implications across time. This is why timing and mechanism matter so much. Phaephilosite Phaeturn 4 file 1 phay. I have no patience for the habit of pretending that all selling is intelligent and all buying is wise. In panics, a great deal of selling is simply mandatory. It may come from institutions with more resources than you have and more information than you have. But that does not make it wise in the sense that matters to a long horizon owner. It makes it necessary for them. Necessary for them may be useful for you. Those are not contradictory truths. When I say I want a long-term asset, I do not mean I want an asset that never hurts. I mean I want an asset whose pain often comes from conditions that cannot last forever. There is a difference. Pain from temporary forced liquidation is one thing, pain from permanent impairment is another. If a business loses its moat, that is impairment. If a reserve asset is sold because the owner must raise dollars into a geopolitical funding shock, that is not the same class of problem. This is where discipline becomes expensive. Not intellectually expensive, emotionally expensive. It is emotionally easy to believe in a secular bull market when price is flattering you. It is emotionally hard to believe in it when the tape is telling a different story every day. That is why most people need price to validate them before they can think clearly. Unfortunately, by the time price validates a structural story, much of the easy opportunity has been spent. I want to be very direct about the type of mistake that ruins people in this phase. They do not lose because they missed a forecast by $20. They lose because they do not know what game they are in. They say they want a long-term reserve hedge, then react to a forced liquidation like momentum traders, or they say they want a tactical trade, then hold through a macro storm like priests guarding doctrine. In both cases, the mismatch destroys them. You need an internal agreement before you touch an asset like this. Are you trying to understand a structural reserve story, or are you trying to win a near-term forecasting contest? Those are not the same activity. If you confuse them, every downdraft will feel like betrayal. The source material provides enough to build a sensible protocol for thought. Watch the lira, watch oil, watch whether the pressure mechanism is intensifying or easing, watch whether the confirmed sellers are still being forced into the market, or whether the emergency is beginning to pass. Watch whether the broad rumors are actually showing up in the data or merely pressing sentiment lower. In other words, stop staring only at the gold chart and start following the machinery that is creating the chart. Fay file a site, Fay turn 4 file 1, Fay turn 4 file 4 Fay. That is how adults approach a market. They do not ask price to explain itself. They ask what pushed price there. Some people want me to turn that into a thrilling prophecy. I have never found prophecy to be a durable investment process. I prefer something more humble and more useful. I ask where the coercion is, whether it is finite, and what remains when the coercion is gone. In this case, the coercion appears finite. Turkey cannot sell unlimited gold. Russia's pre-deadline flow is finite. A war-driven dollar squeeze is powerful. But it is not an eternal state of affairs. And once those pressures ease, the structural motives for official gold ownership do not vanish. They reassert themselves. That is the simple line beneath all the noise. The market always over-dramatizes the phase it is currently in. In a melt-up, people become sure the move is self-feeding and endless. In a reset, they become sure the damage is revealing some hidden truth of permanent weakness. I do not believe either tendency deserves much respect. Markets are moody in the short run and practical in the long run. They eventually find their way back to incentives, and the incentives here are not hard to understand. Governments are fiscally stretched. Trust in reserve arrangements is not improving. Geopolitical fragmentation is not disappearing. Sanction risk is not a fantasy. Developed market deficits are not a temporary hobby. None of that means gold rises every quarter. It does mean the strategic case is anchored in conditions larger than one ugly liquidating month. What, then, is the real test? It is not whether you can say the right macro words. It is whether you can keep the right hierarchy in your head when price is screaming. First comes the mechanism, then comes the flow, then comes the time horizon. Price comes after that. Most people put price first and never recover from the confusion. I would rather own my reasoning than outsource it to a panic. If a reserve asset falls because those who believe in it most are being forced to pawn it for a period, that is one thing. If it falls because the world has become more fiscally disciplined, more politically stable, more trusting of paper claims, less fragmented and less dependent on sanction-proof reserves, that would be another. The source document argues the second condition has not arrived. I agree with the logic of that. What we are watching is stress, not absolution. Fay file a site, Fay turn 4 file 2, Fay turn 4 file 3 Fay. That does not mean you act like a fool. It does not mean you chase every decline with theatrical confidence. It means you understand the difference between being early, being reckless, and being patient. Those are three different things, and the market charges tuition to anyone who treats them as one. I have spent most of my life trying to avoid one particularly expensive error. I never want to sell my future to relieve my discomfort in the present. Most investors do that over and over again. They use immediate price action to bully them out of long-term logic. Then, once the pressure is gone and the logic starts paying again, they call the move surprising. It was not surprising. It was simply too uncomfortable for them to hold through the reset that prepared it. The source document ends with a line that I think many people need to hear more than once. Forced selling does not change the destination. It changes the price at which you may be able to travel there. That is the sentence I would write across the inside of your mind if I could. Because once you understand that, you stop confusing crisis pricing with final value. Fay filocyte, fay turn, 4 file 1 fay here is the truth that matters at the end. The market will always offer you a choice between interpretation and imitation. Interpretation is hard. It asks you to identify the mechanism, respect the sequence, and wait for the pressure to exhaust itself. Imitation is easy. It asks only that you copy the panic of whoever is louder or larger than you are. One path builds wealth, the other builds stories you tell later about how unfair the market was. When this reset is finally over, and it will be over because forced liquidation is finite by definition, the people who kept their heads will not look like geniuses. They will look like people who understood what kind of selling they were looking at. That is all great investing often looks much simpler in hindsight than it felt in the moment. In the moment, it feels lonely. In the moment, it feels like you are arguing with the tape. In the moment, it feels as if the market is trying to humiliate your patience. That is why so few people earn the returns they admire. So I will leave you with the only ending that matters. Do not ask whether gold has become less uncomfortable. Ask whether the mechanism forcing liquidation is weakening. Do not ask whether the crowd has become confident again. Ask whether the strategic buyers still have reason to return when survival stops shouting over structure. Do not ask whether the chart has reassured you. Ask whether you finally know the difference between an asset being rejected and an owner being cornered, because that is the test. Not whether you can survive a bull market while it flatters you. Whether you can recognize a reserve asset being thrown overboard by men trying to keep the ship from taking on water and still understand that once the storm passes, they will want that cargo back. That is when you find out whether you were ever investing at all. That is when you find out whether you were only watching price or whether you were finally reading the world behind it.